still watching Taking Stock on CNBC TV18. Joining us now is Basant Maheshwari, author of The Thoughtful Investor, to tell us how investors should approach this tricky time in the market. Basant, hi, welcome to the show. What's your own advice that you're giving investors at this point? Is it a good idea to go out there and buy, some of the good quality names? And if yes, what are the stocks that one should be looking at now?
Hello, ma'am. First, the thing is, I think the market seems to be divided in between. And without earnings, I mean, stock prices to move without earnings is like trying to drive a car without petrol. So the half of the market, if you see, are devoid of earnings. We thought earnings that would come in FY16, now we estimate them to come in by FY17. And as on date, there's no likelihood, you can't see any ground signals for them to come. So it's the real estate sector, the infra sector. I heard you talk about Jurassic Park just before the show, and the stock that seems likely to become the dinosaur of this Jurassic Park is Unitech. From the Hall of Fame of 2007, it's going into the Hall of Fame. So, and PSU banks, look at the way they're crumbling. With 3.5% net NPA and 12 times leverage, I think more than 40% of the book value is under cloud. So, even in spite of these stocks having fallen so much, I would advise investors not to look at them. Instead of them, we look at the private banks, because once PSU banks are into that kind of a scenario, they would stop giving loans and they would actually give back market share more to the private banks. So if investors have to choose, they're going to be with the top quality private banks, Kotak Bank, HDFC Bank, and things like that. And these are not recommendations, they're just examples. And buy a little expensive and stay with them. That's the writing on the wall right now. Instead of trying to be the big cheap stock picker, I think it's better to buy a little expensive and buy certainty.
Well, in fact, we've seen a very sharp divergence in PSU as well as private banks this entire week, with PNB, Bank of Baroda down nearly 8%, and ICICI Bank, on the other hand, was up nearly 4%. But hi, Basant, what's your view on the index now? Because the fear is we've closed below that 8,000 level, and we've conclusively broken that, psychologically important level, and perhaps now levels of 7,600, 7,700 are also in store for us. What would your view be on the index now?
I think the Nifty doesn't reveal the pain, it just hides it. The Nifty has fallen what? Only 15%, not even that from the top. But individual portfolios would have been slaughtered by 30%, 35%. And that is because the Nifty has got the Infosys and the TCSs and the levers, and of course lever has fallen a little bit. So these kind of stocks don't fall too much. The HDFC banks and the Kotak banks, they are like the magnets of the Indian market. They don't fall too much in any case. But the individual portfolios have been slaughtered. So even if Nifty falls 5% from here, my worry is that the kind of stocks which people actually own in their own portfolios, they're going to get down by 10% or 12%. So 3, 4, 5% is nothing for a market, but those kind of stocks would fall. I don't think the Nifty is going to fall too much from here. Of course, I'm not a great forecaster of where Nifty can go, but from the sense of it, we are actually looking at the worst and things like that, but the Nifty won't fall. But the point is that there are stocks which cannot just go up without earnings. And once this kind of fear sets in, it is very difficult to ask a retail investor to put in more money. All he is now looking at is the value of the portfolio going down. But in such circumstances, if you have to buy, don't try and average first thing. I mean, if you bought a Bank of Baroda which is down 20% from your purchase price, let it be that way. Don't try and buy more of it just to average it up. Of course, it can show you a bounce. Buy the good ones, buy the predictable ones, and just sit on that and don't hope and pray. Just look at the earnings. If the earnings will come, everything would happen. Hoping and praying wouldn't work. But I think I would actually be out of PSU banks. Though in PSU banks, you will see the biggest rally if the Nifty goes back 400 points from here. And that again is going to suck everybody in. Because, when you see stocks going up 20%, 25%, and that time HDFC Bank would move up maybe 7% or 8%. So again, people would go in there. With PSU banks and most of these banks, the problem is that if the economy does not revive, the net NPA figure and the gross NPA figure is going to worsen out. It's not that if we don't recover in 6 months, these figures are going to get bad. And plus, they don't have capital to lend, so they are right now in a recovery mode. So that is how the scenario is. But it's really painful. I mean, let me tell you, it's painful for everybody, for a retail investor, large investor, small investor. Nobody loves to see stock prices going down. And we all say, I mean, when prices go down is the best time to buy and all that. But and buy when there is blood on the street. But what do you do when it's your own blood on the street? That's what the scenario is right now.
Well, I like that analogy that you just used, you know, comparing Unitech to the extinct dinosaurs of Jurassic World. I mean, that stock is anyway on the brink of extinction in any case. But you spoke about private sector banks and your interest there. What else? What else should investors buy at this point? You know, we all know private sector banks, the defensive names, the pharma stocks, but tell us something different. Tell us some mid-cap names that you must have identified which can become the next, say, Eicher Motors or the next UPLs of the world.
No, nothing like that actually. But I think, you know, what happened between 2003 to 2007, when nothing was happening in India, most of the Indian entrepreneurs, they ran out. The Tatas went and bought Chorus, they bought JLR. So I think if nothing is happening in India right now, you've got to look at sectors that are outside of India. So not in the small cap space, in the large cap space, Cadila is a good one. They can give you 25%. They've got a lot of interesting things happening. Torrent Pharma is good. So I think a mix of these things should be good. But it is better in these times not to look at the mid caps, because unless you're very sure of the mid caps and the small caps and that earnings are going to come, but just buying mid caps just because the markets have fallen and assuming them to be, see, with Eicher or with UPL or with any other stock, those mid caps became large caps because they were leaders of their own sectors. So if you can find a mid cap or a small cap that are leaders of their own sectors, then they have a chance of becoming big. So if I buy a Heidelberg, just an example, which is a small cap in its own space, but it's not a leader, it cannot become as large as Ultratech. By the time Ultratech would have become bigger rather. So if I have got to buy a mid cap or a small cap, I would focus on that mid cap or that small cap, which is a leader in its own space. So that's the way to do it. But for the smart guy, when it's raining bullets like that, it's best to get behind a sand bunker and just wait and see. And I think the best time right now is to look at large established players rather than try and find out the next big thing.
Okay, moving on, you know, you also spoke about how one should, you know, select predictable companies. You know, ITC used to be predictable, but it's fallen below 300. You know, Tata Motors has seen a fall all the way from levels of 600, and that used to be such an outperformer. What would you recommend in names like an ITC as well as Tata Motors now?
ITC was predictable in sense of its business, but it wasn't predictable with what the government would do. So the regulations ensured that ITC remained, of course, a predictable company from the business point of view, but the regulations were always uneven, and from single cigarettes and packets and things like that. Over a period of time, we've seen that once the government gets after anything, it's very difficult to make money out of it. And Tata Motors, I mean, in spite of all the Chinese hue and cry and JLR and all that, I think the first stocks to recover would be the good ones, the Tata Motors and things like that. But even in any case, I mean, it's the question of predictability comes to the fore when we have to assume the long-term predictability of a business. So to that extent, I think still the private banks, the NBFCs, they're as predictable as anything. And HDFC Limited, for example, it can be predicted for 20 years because you got a 20-year history behind it, an HDFC Bank and things like that. Because in these times of it's very difficult to actually. Now let me put a disclaimer here. I mean, I'm not putting in a gloom and grief scenario. I'm fully invested. I intend to remain invested. I am bullish. I just feel that the bull, he's been slaughtered. He's not slaughtered actually. He's been bruised and battered, and he's weak and he's taking some rest. He's sleeping, but he isn't dead. He's going to come back. Once the government starts spending under Q3, Q2 of this year, I think we're going to get something by the end of this year, calendar year, and that's when we resume our uptrend. But till the time, we have to take the blows. I mean, that's how markets are. We can't have it one way all the time. So that's the thing.
That's true, Basant. And as you know, as a wise man once said, investors should always thrive on corrections and not on rallies. So if one uses this time to accumulate, just leave us with a couple of stocks or a couple of sectors that you would be recommending right now. Stocks preferably, of course. I know you're great at picking value buys. So what's on your radar at the moment?
A blind buy in this situation would be the non-banking finance companies, the NBFCs, specifically relating to the housing finance sector. I mean, you can buy them 5% or lower, 5% up from here. Keep them for 5 years, for 10 years, keep them for 15 years also. The two which I own, obviously you know them, Western India and Southern India, those type of companies. I wouldn't like to take names, it's fairly apparent what I'm trying to say. But I think those kind of companies, you just buy them and keep them. You buy them 5% lower, 5% up from here, it doesn't matter. I mean, it wouldn't matter to you today at what price you bought HDFC Bank in 1999, whether it was up or down, it doesn't matter to you today. You bought 10% up or 10% down. So, but investors have to reconcile to the fact that mid caps and small caps especially can fall 20% without reason, and by the time they fall 30%, you have a reason, but then you say it's already discounted in the price. So those are the perils of investing in mid caps and small caps, but that's what make you money. That's what can really create wealth for us. So that's how it is.
Okay, Basant, we'll leave it at that. Thanks for joining us and giving us some pearls of wisdom on how to invest in a market like this, and leaving us with some ideas as well. Non-banking housing finance companies, that's one theme that he's working with. But on that note, we'll wrap up with this edition of Taking Stock. You guys have a good weekend. We'll see you again on Monday.